Good afternoon and welcome back to the latest edition of the InvestTalk market analysis for the week ending June 28th, 2024. Thank you all for tuning in, liking this video and subscribing to this channel. I am host of InvestTalk, Justin Klein, and today's video is going to be titled "A Disaster for Biden Reverberates in Markets." And this was really the story of the week. We had the first presidential the first presidential debate on Thursday, and it was a disaster for the current president. And you can see that in betting markets here. On the 25th, we had Trump so this is predicted. If you ever follow this, is predicted.com. These are betting markets. You can actually bet on who wins the election. And there's some third-party candidates down here. RFK was at 4%. Newsom went from about 5% all the way up to 17, has settled back into about the 11% range. But Biden has not recovered because he started at 47% to Trump's 52, and now he's all the way down, hit 33 on the low, now up to 36. But Trump has stayed right around that 58% mark. So, pretty nice bump for Trump and a big dump for Biden. And it's pretty clear that this is headed for Biden to bow out. Now, I think we'll know in the next couple of weeks because the Democratic Party will have to go through a process to figure out who the candidate is, and they're going to need at least a few weeks to get that done. So I think we'll know by middle of July at the very latest. But that did reverberate in markets. The increased chance of Trump winning, and Trump's economic policies, at least the ones that he's talking about with high tariffs and eliminating income tax, et cetera, would be extremely inflationary. You think we had inflation the last couple of years? You will see nothing. You have seen nothing yet if the Trump playbook is implemented. And I'll show you why and that's why the markets moved. And we'll look at that here in a bit. But first, I want to go over the economic news of the week. We had the Fed manufacturing index that came in at -10. So the manufacturing index remains, since really the fall, has remained in contractionary territory, at least in the Richmond region. The single family homes sold, that did tick down to the lowest level since November of last year, and headed towards the lowest level since late 2022. So we'll see what that looks like. Obviously, interest rates going up on this election news is certainly going to hurt that. And this is for May. Now we are in June, so we'll get more information, but this is fairly lagging. So just to take note of that. The Kansas City Manufacturing Index. Now this is of June, so we had the Richmond, we have the Kansas City. That's also at -11. So the manufacturing side of the economy is not doing so well, and a lot of that has to do with the strong dollar. The dollar has been strong lately, and we know that is bad for domestic manufacturing competitiveness. Pending home sales, that was down once again, -6.6% year over year. But considering where interest rates are, it's frankly not a terrible number. And obviously a slight improvement from April. But clearly the housing market is taking a leg lower, just as the employment situation in the country is taking a leg lower. This is the continuous claims for unemployment, and you can see that had another tick up this week to 8.4 million, the highest levels in over let's see, 8 point, that's 3.9, since April of last year, basically little over a year, 15 months, call it. And we're not far off from the new highs since early 2022. So I think you'll get there sometime in the next couple of months. Now, the inflation data, the 12-month trim mean PCE, this is one that the Fed follows. This is one that definitely the Fed is paying attention to. And that actually was a positive surprise. And you have to remember this because this came out on Friday. And I'll show you here the charts on treasuries, for example, longer-term treasuries, and those were down. That should not be the case when you get this good inflation number. Okay, so know that there's two opposing forces here: the results of the debate, and then this inflation number, and they are diametrically opposed. And we'll see, which one won out on the charts here in a minute. Consumer confidence sentiment that ticked down a little, but remains okay. I don't think it was really a big news one way or the other. Now, when it comes to the markets, what they're pricing in, now you continue to kind of coalesce around this September rate cut. And I think that's true. You see what's happening in the jobs market, the manufacturing industries. The economy is taking a leg lower. And the Fed has talked a lot about how we are in restrictive policy and we want to get ahead of anything. The inflation numbers continue to be okay. So they're definitely acting more dovish. And the mean dot plot was one rate cut by year end, but I do think the economic data will continue to weaken between now and September. Now the next meeting is in the end of July. I don't think in the next month they'll be as clear, but that might be a period where they start to indicate right by the end of next month, hey, we're likely to cut in September as long as the economic weakness persists, and I think that will be the message at the next Fed meeting, and you likely get another one to close out the year as well, and that's why you're actually up to about 2.5, maybe 3 rate cuts. Yeah, this would be 2 rate cuts here at 43%. So a decent chance there'd be 3 rate cuts, and a very small chance there'll be 4 rate cuts by year end. So that's kind of where we're at. But how did that manifest on the charts? That's most important. And I'll start off with the TLT. So as I said, the Trump playbook for the economy is extremely inflationary, and that manifested in the bond market here, right? If there is a resurgence in inflation, that will be the worst thing for the bond market of any asset class. That will be the worst thing for the bond market, and that's why you're getting a requisite sell-off, despite that better than expected inflation number right now. The bond market is looking at the higher chance that Trump will now win and pricing that into markets. Okay, so here's the TLT, the IEF, that's the 10-year, right? Not quite as long term. And then you look at SHY, which is short term, that was actually up. So it shows you that the yield curve steepened, the long end went up because those are going to be more sensitive to an inflationary environment. So that's something to consider. And then if you look at certain companies, so you have CXW. This is a jailing a REIT that owns a bunch of prisons. Obviously, a Trump administration is going to be more friendly to the prison industry than a continued Biden administration or just continuation of a Democrat in office. You have other sectors like steel. Here's Nucor. That was up nicely. US Steel, that was up nicely as well. And this is in context to the S&P, right? Friday, that was down and closed near the lows of the day on pretty good volume. So I think that's certainly of note here is that you had the market really sell off throughout most of Friday and close near the lows. Okay. Pretty much right at those lows. So, and I think the higher interest rates have a lot to do with that, right? You can see that really bonds sold off all day, equity sold off all day. It was a bet. And that's what I think is going to be interesting. A lot of people are going to think that a Trump presidency is going to be good for stocks again. I'm not so sure because if his policies are implemented and you have high inflation, a ton of debt, currently in the system, that may be a big problem for the long end of the bond market, and that would have major ramifications, not just in bonds, but bond proxies like utilities, as well as longer dated assets like tech stocks, for example. And that's why you saw this. This is growth to value trade. And this sold off throughout the day as well, right? You had this kind of close at the lows of the day. So the growth stocks will certainly be hit the most, I think, if a Trump administration does happen, a new Trump administration does happen. So be on the lookout for that. What else do I want to get to? Let's go to gold. Actually, let's go to gold. So this is GLD. That was about flat on the day, which is very interesting considering the sell-off in treasuries, higher interest rates. Typically, that's bad for gold. Gold was flat. And that's just indicating once again that you're likely to get an inflationary environment going forward. Silver to gold ratio, that still remains an uptrend. No real issue on that front. Some of the other Trump trades. What were they? I know I had them up on another screen. Oh yeah. So companies like General Motors and Ford, so obviously tariffs are going to help them. So you saw those up as well, domestic manufacturers, and then LNG, right? So here's Cheniere. Obviously, the Trump administration is going to want to expand our export of LNG because they're more, oil and gas. He's more oil and gas friendly, and not nearly as worried about climate change. So that was up nicely as well, and it's been up as of late. So. Very interesting week on the political front. I usually don't talk politics, but at the end of the day, if they affect markets, you have to talk about them. You can't ignore it. And especially in today's environment where you have fiscal dominance, where it's all about the government spending money and the bond market financing that. So if you get a problem in the bond market, that manifests in a potential reduction of spending in government. Okay, and the move index is that started to move up as well. So we'll see if this gets a breakout because an inflationary environment would likely precipitate a more hawkish Fed and a more challenged bond market, treasury market. So just understand that and this is not me trying to be political at all. I call myself very much independent. I think both of the current candidates are very rough and have their major issues, and that's frankly 70% of the country. So I don't think I'm in the minority there. But what you have to do is look at the trends and really call those balls and strikes. And let's do that with the S&P here. And like I said, this closed near the lows of the day, and it was this is a micro bearish pattern. So I do expect a choppier market going forward. And you see the NYSE that continues to kind of chop sideways. And I think we're going to likely go into more of a market with rotation. So the industrials have been consolidating, and if you get the dollar declining, I think that would certainly help the overall the commodity markets. Let me pull that up here. There you go. This is the commodity index that has pulled back. A lot of that has to do with oil. Here's the USO, but that has rebounded as of late. So pretty mixed bag overall in the commodity space, but that's with the strong dollar. So I still think there's some nice relative strength overall considering that strong dollar. The Nasdaq did have once again a mini sell-off near the end of the week, and I think this is ready to roll over as well. We talked about Nvidia and having that with that major reversal on top, and this is just a consolidation period, right? We're hanging around this 120 level, and it's pretty clear that this is probably headed lower. Probably to the 100-day moving average is going to be the next major support because you already hit the 50 and pushed higher off that. I think this area, the breakout area where this broke out, kind of around the 95, that's the next support level. And obviously, that's being a large part of the overall indices now because Nvidia at one point recently was the largest company in the world. That's going to weigh on the broader index, especially the Nasdaq. So I think you're likely to see that head lower in the short term. Here's SMCI that's also showing that relative weakness. A lot of those AI trades, the Adobe, that one had a rebound. That's showing some strength, but it is into some major resistance here. So be careful on Adobe. What else do I want to get to? Tesla, we'll line up Tesla here, also into some major resistance, and I can see that rolling over next week as well. Let's see, what else do I want to get to? Let's get to the credit markets. So if we look at, let's see if I can find it here. There we go. So here's short-term junk to short-term treasuries. That did weaken throughout the week. Not a breakdown yet. And I'll be watching to see if you get any movement here. The credit markets are still holding in there, so a major sell-off in equities will not happen unless the credit markets start to unravel to a degree, and we're just not seeing that quite yet. So that's kind of where we're at. I know I've been going on for a little while, so maybe I'll cut it short here. But just a reminder that this is all about how this manifests in markets. That's all you should care about as an investor. You need to throw your political biases out the window and say, what are the facts on the ground? What's the reality of the situation? Are we headed for one president or another, whether you like it or not, or love it or not? It's all about how that will impact the economy, impact uh, the different sectors and industries that are out there, and asset classes, as we talked about, bonds versus equities. And so just be mindful of that, and try to throw out your preconceived notions. You know, just like I said with Trump, right? Trump, no matter what you say about him, the economy was okay. I think it was probably not as good as he thinks it is, but it wasn't terrible, right? We weren't in a recession. Um, it had issues, just like every economy has issues. Um, but his new policies are a lot different, right? And so you almost have to throw out the first Trump administration and say, okay, well, what do these new policies likely mean? And be fair about that. Once again, whether you like it or not. And maybe you could say, and I think probably the best argument is, he might say one thing, but the true manifestation of those policies will be somewhat less, and so more tempered, and less inflationary. That's the argument. But you have to look at them as they are likely to happen, not as you hope or wish or pray that they happen or not. Okay, so as we go into this election season, do your very best to throw your political biases out the window, because it's one of the surest ways to create losses in your portfolio is to hope for an outcome, invest accordingly, and then not have that outcome come to fruition. For example, I'm an independent. I frankly wouldn't want either one of these to win the election. Do I think that's the likely outcome? No, I don't. I have to, call it like it is. And so, and just like if Biden gets replaced by a generic Democrat, shall we say? I don't want to throw one out there, but let's say a generic Democrat, they're probably going to have a much better chance at beating Trump than Biden will at this stage. So if that happens, then you have to change your thinking accordingly. Despite the fact that I probably wouldn't want the generic Democrat to go in there, right? So it does not matter what you think, how you think about the political situation. It doesn't matter. All that matters is how the market interprets it, how the market thinks that the future path of the political situation will unfold. Okay. And they're going to price something in. Now, you might think that that future path will be different, but don't allow your political biases to creep into how you think the reality of the situation will be. Okay. So I appreciate you all tuning in and liking and subscribing once again. And I hope you have a wonderful weekend. A reminder, the contents of this video are for educational purposes only and should not be construed as a recommendation to buy or sell security or to participate in investment strategy. The views are my own and do not represent those of KP Financial or those associated. Have a wonderful weekend.